right, welcome back to Bit Center. We discuss current financial topics and Bitcoin. It's tough for most people to keep up with all of it, so we help explain these topics and current happenings. My name is Win. Make sure and hit the subscribe button and the bell so you can be the first to see our new episode. We provide you all the links to the content in our show in the comments below.
And I'm rolling. It's Sunday, March 7th, and thanks for tuning in. I've got a good show for you today, and we'll be discussing current yield curve dynamics and its implications, inflation and how it affects consumer and asset prices, companies' stock performance who hold Bitcoin on their balance sheet, and how Bitcoin is currently reacting to the global macroeconomic landscape. Let's dive on in. So yeah, this first topic we'll discuss is the yield curve and the current dynamic.
All right. So first, Roland, let's can you help me and maybe others who aren't haven't done the research on it? Can you kind of brush us up on what the yield curve represents?
Yeah, so the yield curve represents the interest rate on treasury bonds. And so there's short-term bonds, it could be months, and then there's long-term bonds, 10-year, 20-year, 30-year. And so the typical one that you see in the news is the 10-year treasury. And so it's last year it was around 0.5%. And over the last 12 months or so, it's been going up. As you can see on this chart, it's about 1.5% right now. And so you can see this curve, it's curving upwards. and that has a lot of implications. And so basically, when you have a bond, it's a loan, right? It's a loan, and you're giving the government money. So you give them $100 for a 10-year bond, and the coupon rate, which is your annual interest, is $2, right? 2%. So you get that 2% on your $100 bond every year until the bond matures, until you get the $100 back. Well, in the secondary market, these bonds are traded all the time back and forth as the market dynamics change, right? Inflation, deflation, things of that sort, and demand. And so if I sell my $100 bond to someone else for $102, well, that $2 coupon, that 2% interest that they're getting is a lesser percentage of what they paid for that bond. So the bond will decrease, right? So it's kind of an inverse relationship. As bond prices increase, the yield decreases, and vice versa. So that's kind of what we've been seeing. We've been seeing a lesser demand for bonds because the market is anticipating inflation in the coming years, right? We've seen governments around the world print trillions and trillions of dollars. And so the market's expecting that prices are going to go up, right, in the coming months and years. Something interesting to note is bonds, the yield used to be very high many decades ago in the 70s and 80s. And so ever since then, it's just been decreasing and decreasing and decreasing, which, is pretty good for the economy, right? Because if money is cheap to borrow, you're going to borrow it and you're going to go spend, right? If a mortgage is 10% to get money to buy a house, you're going to maybe think twice about it. But if it's 2%, you'll say sure, and you'll buy that house for 2% that the bank gives you.
And the flip side is going to be decreased liquidity for everybody, correct? As money's easy.
Yeah, exactly. And so you're exactly right. And that's one of the worries is deflation, right? Governments don't want deflation. I mean, no one really wants it. It's not good, right? Because it kind of slows the circulation of dollars in the market. And, it's good when people are buying things and selling and there's high employment, right? So in an inflationary environment, employment is typically higher because dollars are moving a lot. And so we've been seeing that yield curve kind of go up recently. And one of the other aspects of that is we've seen riskier assets like tech stocks, they've gone down because people are saying, well, we can get a pretty much risk-free 1.5%, from the government. These treasury bonds are backed by the full faith and credit of the US government. So yeah, we've seen some riskier assets go down recently as that yield curve goes up. So the government needs to, well, they don't need to, but they've stepped into the market and said, well, we'll buy bonds so that the yield doesn't go too high, right? Because again, as that yield goes higher, it's going to be more expensive to borrow money. Banks borrowing money between each other, consumers like you and I borrowing money for a car or a house, or even credit cards. People they're not going to borrow as much, and then that means they're not going to spend as much, and then GDP goes down and the economy kind of slows down, and so that's not good, right? You don't want to go into a recession, and so that's their thought process. So the government, they'll step in and they'll buy bonds to bring that yield curve back down to 1% or 0.5%. And so again, that'll basically be fake demand, but it's demand by the government. And so they'll bid the prices up on those bonds, and the curve will go down. But yeah, that's basically quantitative easing. And so we haven't seen them do it yet, but they might. And just depending on the environment and what's going on. So some skeptics have said that this is going to be bad for Bitcoin, right? Because people say Bitcoin's a risky asset. People treat Bitcoin like a tech stock, or it's speculative. But Bitcoin has been pretty strong recently. The high was 58,000 in February, and we're sitting at around 51,000 today on March 7th. So Bitcoin has been very strong. And I think that gold 2.0 narrative is really catching on, and people are understanding the value props of Bitcoin and how it has those sound, hard monetary properties that fiat currency obviously doesn't have, because it's printed out of thin air. And Bitcoin is very hard to produce, and the annual supply issuance is decreasing all the time. So I think that narrative's catching on and people are understanding. But yeah, Bitcoin hasn't dropped nearly as much as many stocks have, as the yield curve has been increasing. So, and we have a couple links for you that we'll leave. One's a podcast, Preston Pysh talking about the yield curve, and another is a good article on the yield curve and bonds and what's going on. So yeah.
Nice. Yeah, really good stuff, Roland. All right. Now I kind of want to get into inflation. I think this is a good transition point.
Yeah.
The yield curve, bonds, CPI, different metrics. We're all kind of trying to figure out inflation, and the reason why that's important is because inflation is going to determine how much value your dollar loses every year, how much value your wages are going to lose in purchasing power every year. So it's really important. And if you watch mainstream media or you watch government officials, the main metric that's going to be referred to is CPI, the Consumer Price Index. And the CPI since 1980 has been between 2 and 3%. And, according to most, economic textbooks, the goal of the Federal Reserve is to keep the inflation rate low and predictable. So they go for goals of around 2%, which means they're on average trying to create 2% of inflation. And, what that would mean in general for us is losing 2% of purchasing power every year. However, CPI is not inflation. Inflation is very complex and relates to different assets differently. So,
what makes up the CPI? I mean, I know they change it often, right? Like the basket that makes up CPI.
Yes, exactly. Yeah, the basket does change. And if you go on a government website, it's going to say that it takes into account certain housing changes. It's going to say it takes into account certain medical expenses, but in general, it's a weighted average of mainly consumer goods. Yeah. And, while it takes into account certain things like other asset prices like homes, it doesn't distribute them evenly enough to really get a good picture of inflation. In general, it is kind of what it's titled as, a consumer price index. And no matter who you are, at some point, we all have to not be just consumers. We all want to be investors too, because we all want to retire from our jobs at some point.
So, and allocate wealth. And so even if they do include homes as assets in there, it could be like a small weighted percentage, right? They could just say, yeah, we include homes in there, but it could be a tiny weight, maybe. I don't know.
Exactly. Yeah. So the decrease in price of goods like eggs or milk, or the small increases in all these consumer prices on a weighted average could make it appear, as the economic textbooks would say, that it is I'm sorry.
And technology, things like, phones or computers, they were super expensive when they first came out, and over time technology advances and it gets cheaper. So
Right.
that's one thing that kind of counterbalances it and keeps that number low for the government.
Definitely, yeah, and yeah, great point to bring up. And on that note, I'm going to recommend Jeff Booth's book, The Price of Tomorrow, where
Yeah.
he pretty much lays out that argument that technology
Yeah.
is this massive deflationary force, and the Federal Reserve, by their dual mandate, is trying to create inflation every single year. And it's becoming more and more difficult as technology becomes more and more deflationary, and it's more and more difficult to accomplish all these tasks as money is devalued every single year. And almost what you're supposed to believe is that it's a negligible rate of inflation, that 2% is negligible. And I kind of want to look into why, first of all, 2% is not negligible, and also why the real rate of inflation is actually much higher. So we need to analyze not only consumer goods, but investment assets. We have to analyze scarce assets, because that's where money's going to go when people are looking for a store of value. And when the money supply is increasing, as discussed earlier, 25% per year, with expected 15% growth in the next 2 to 4, maybe more than that, um, a store of value is going to be very important for all of us. So seeing how these assets are going up in price is going to determine the real inflation rate in those different asset classes. So let's
Yeah.
look at real estate. Real estate has been the major vehicle for people to build wealth in order to retire from work, and to pass down wealth to increase the security and opportunities available for their family and future generations. So, according to government websites, the home price index, known as the HPI, which is more relevant to home purchasers than the median or mean price of real estate, because it takes into account different value additions in the home, bedrooms, baths, anything of value that's in the home, and it relates only to single family homes. So, for the vast majority of individuals, this is a much better look at real estate than averaging everything together. The home price index since 1980 has gone up on average 8.6% per year. And if you look in desirable locations, places with better education, better job opportunities, less crime, those kinds of things, you're going to see desirable locations going up easily 10 to
Yeah.
15% or more per year.
Yeah.
So, in order to kind of make a judgment on whether that's high or not high, we then have to look at the wage growth. All right, so let's take a look at this chart here, which summarizes the average wage growth from 1980 through 2018 for the bottom 90% of earners. So for the bottom 9 out of every 10 people, their wages are going up less than 1% a year. It's going up
Yeah.
0.6% a year. So even the previously discussed mandate of the Federal Reserve to create a negligible 2% rate of inflation, they are creating a rate of inflation that's outpacing wages by 4 times per year, 4x per year. And if you
Yeah.
want to buy a home, real estate's going to be going up 10 to 20 times per year, and more than that if you want to get a home in a desirable location. So the only way out of this struggle, the only way out of the battle of work at this point, is to work more and more to save more and more money, and then eventually purchase a home in a less desirable location than what you're actually looking for. So,
Yeah.
this is why inflation is so important. This is why the yield curve is so important. And if you're not paying attention to investments or inflation, yeah, you're going to miss out every single year. Every single year you don't get a 10% raise, homes are going to be more expensive for you to purchase.
Yeah. That's why the wealth gap has been increasing so much over the last years and decades.
Exactly. Yeah, the wage
Yeah.
growth since 1980 has been flat. Um, However, there's been all this growth. All the money is going into the hands of the top 5%, the top 1%, and you know the top 0.1%. So
Cantillon effect. Yep.
so it's very interesting that the Federal Reserve, which is a private entity, not full of elected officials, has a say on what your money's going to be worth and what you can purchase in coming years and when you can retire from your job. And
Yep.
there's no way to vote out any of this policy, and there's no signs of it changing anytime soon. So this should worry you. This should worry everyone.
Oh, we got Bitcoin. Thank you, Satoshi.
That's right. Bitcoin seems like the only way out at this point.
It's the only money that makes sense. Bitcoin is ethical money.
It is. It's an incredible invention, and education is key. You got to look into it for yourself.
Yep. Do your own research. All right. You may talk about some stock performance.
Yeah, let's talk about MicroStrategy, among others. What's going on there?
Yeah. So, yeah, it's been pretty crazy the last few days, weeks. As we've seen some of these tech stocks go down, right? We talked earlier about it. The yield curve has a little bit to do with that. But MicroStrategy, as you may know, may not know, they put about $500 million of their company assets into Bitcoin last fall, around August timeframe, I think it was. And that was a very good percentage of their overall market cap of the entire company. It was a high percentage, I think 30, 40%, maybe more. Since then, they did a 600 million convertible bond, and they bought Bitcoin with that. And then they recently did $1 billion convertible bond and bought more Bitcoin. So they have about 90,000 Bitcoin now. And the vast majority of their market cap is in Bitcoin. And so as you can see, this chart right here that I have pulled up, MicroStrategy, their stock was around $120 before they started acquiring Bitcoin. $120 a share. It skyrocketed up to $1,315. And recently it has drawn down quite a bit. It drew down to $537. So that was a 60% drawdown. And Bitcoin, it drew down from 58,000 at that same time when February 9th was when it was. MicroStrategy hit 1,315 on February 9th, and Bitcoin was at 46,000 at that time. And then over the next few weeks, MicroStrategy fell to 537 by March 5th, a couple days ago. And on that same day, Bitcoin is at 49,000. So actually in that same exact time frame where MicroStrategy drew down 60%, Bitcoin actually went up about $3,000 from 46 to 49. So basically what we saw is MicroStrategy got highly overpriced, and there was like close to a $2 billion premium. I think it was $1.6 premium that was priced into that stock. And so there's a bunch of entities that can't buy Bitcoin directly. They can't buy the underlying asset outright, but they can invest in equities. And so in order to get Bitcoin exposure, they can invest in some equities that hold Bitcoin on their balance sheet, like MicroStrategy. They hold a lot, right? 90,000 now. So that's kind of what we saw. There was a big demand, a big surge, right? Because the U.S. doesn't have an ETF yet, a Bitcoin ETF. We saw Canada recently get a couple, but the U.S. still hasn't gotten a Bitcoin ETF. So yeah, what we saw is a flood into MicroStrategy, and then they drew down about 60%. And so now they're around $600, give or take, right now, and which is actually a 4.5x from where they were prior to acquiring Bitcoin. And at that same time, the Bitcoin price was around $11,000, and a 4.5x is about where we're sitting now. So it looks like the market they're learning how to price it better. They're being a little smarter about it, and not FOMOing in as much. I mean, we could see it again in the future, who knows, but it was really interesting to see that. Yeah.
I think it kind of went along the lines with kind of other stocks and things we're seeing these days. When something starts jumping a whole bunch, you have a whole bunch of FOMO. You have a whole bunch of people kind of jump on that ship, and then when it starts to tank a little bit, they kind of jump off. So I think you're right. I think it's more priced into the market now, and maybe yeah, of course you're going to see short-term traders jump on and jump off here and there, but yeah, it really is the institutional ownership that's really interesting.
Yeah, and I have another one. Tesla pulled up, which they obviously, you know, they started at, I think it was, let's see here. Yeah, I'll pull it up on the screen. So Tesla, I mean, they started out at like $70 just 12 months ago or around that time frame, and they shot up to $900. Uh, and it wasn't just because of their Bitcoin. They only recently acquired Bitcoin, but yeah, I mean, just exactly what you said. When there was just, it's kind of like a momentum stock. There's a lot of momentum trades going on recently, and momentum buys, momentum stocks. So that is definitely a trend. And so, yeah, Tesla, they went up to 900 and they acquired 1.5 billion in Bitcoin, which isn't as big of a percentage of their total assets or, cash that they had as MicroStrategy. I think they had around 20 billion in cash. When they bought that 1.5 billion, I think it was February. But it's still, still a good amount, right? You're close to 4%, give or take, or no, more than that, actually. That's yeah, that was actually a good amount. Like, how much is that? It's like 10%, about close to 10%, a little less. So yeah, we saw them draw down not as much as MicroStrategy, but still a decent amount. And that also had a lot to do from going from 70 to 900 just in 12-month time frame. So, there's some expected cooling off there. But yeah, another interesting one. One other one is Square. So Square, they bought 50 million in Bitcoin last fall, but it was smaller than Tesla, smaller than MicroStrategy, 50 million, and it was only 1% of their total assets. And then in February, they nearly tripled it, a little more, and to 170 million in Bitcoin. And so now their Bitcoin represents 5% of their total assets. And so they didn't draw down near as much. They drew down 23% in the last week or two. From 283 to 216. So yeah, some interesting dynamics. It's cool to see how the market's, trying to price this stuff, price discovery of these companies holding varying levels of Bitcoin on their balance sheet, right? Trying to gauge what percentage of their Bitcoin is makes up their market cap. And, MicroStrategy, they're continuing to buy I think every time they get excess cash flow, they'll just put it into Bitcoin, right? They keep a small amount for working capital, but any excess, they just dump it into Bitcoin. We see these, $10 million buys here and there. So it's pretty neat to see.
Yeah, and I think that these kind of dynamics of Tesla going up so high, other stocks going up so high, and being so volatile is relating to both the previous dynamics we talked about, the treasury yield and the real inflation rate of real assets. I think has a lot of people feeling like the only way to get ahead, the only way to get some of the things they want to purchase is to kind of take more risk and to take some of these high risk stocks. And as we've seen in a stagnant price of gold, they're not only being used as a form of growth, people are using Tesla and other tech stocks as a store of value, because not because it's not volatile, but because what else are you going to do? Nothing makes sense. And if you don't already have hard assets or scarce assets, you're forced to look to essentially tech growth stocks. Or I think if you're really doing some real analysis, you're looking towards Bitcoin, and you're at least owning a little bit of Bitcoin. But yeah, it's people are struggling just to maintain. If you have to make 10% more just to maintain, you have to go for these high growth opportunities, these Teslas and others. And if you don't, you're losing every year. As Sailor says, your battery's draining, all your hard work.
It's a melting ice cube. Yeah. And I mean, that's how central banks and governments are structured, right? They're structured to punish savers and to force you to take risk, they're forced to invest, right? You're forced to, invest in risky assets and things you might not understand. I mean, we've seen an explosion of people, investing in the stock market over the last 12 months compared to ever before. That's just how it's set up. And so Bitcoin is bringing back saving and giving people an option to just save and not have to take risk, right? And study the markets and try to know what to do.
Yeah, the money's easy and free and seems to be getting, easier every day. And there's
Yeah.
no return. There's no incentive to save your money in cash. There's no return to save your money in something safe. So again, it's turning into the same issue that we had in 2008, which wasn't the housing market. It was the liquidity crisis. No one's incentivized to have liquidity because you're punished for having liquidity.
Yeah.
So in downtimes become even worse as we sell off assets, forcing further Federal Reserve and government manipulation of price control and stability. It really seems like you know, you know, chasing yourself in a circle over and over. You
A
can't,
vicious cycle. Yeah.
a vicious cycle that doesn't seem like it can end.
Yeah.
So yeah, people are,
It'll
you wonder why everybody's, investing their money. Well, it's because they just got a whole bunch of free money and nothing else gets any return.
Yeah. Yep. That's exactly right. What else you got?
All right, buddy. So yeah, kind of, I feel like tying everything together that we've discussed here. Yeah, how is Bitcoin fitting in? How is it reacting? How are people's opinions changing in this global kind of macroeconomic landscape? Um, Monetary policies, the money supply increase we discussed last year, coupled with, the idea based on the past and looking at it that it's not going to stop anytime soon. Um, these monetary policies are going to affect you worse. The more poor you are, the lower you are on the economic ladder, the more detriment these policies are going to have on you. And yeah, I got a question for you, Roland. Kind of tying this together with kind
Yeah.
of what we've seen recently this year and previous years, actually, and the power of Bitcoin to kind of empower individuals in countries who are experiencing economic or civil crisis, kind of the unbanked, the lowest economic strata people worldwide. We've really seen an uptick in Venezuela and elsewhere of them finding
Hmm.
utility. Um, will we begin to see the economically disadvantaged classes in this country kind of seize the opportunity of Bitcoin? Will it be too late? Is there too much fear, uncertainty, and doubt kind of in the media? Because it seems to be the worse off you are in the world in these countries, the more Bitcoin, it seems the more attractive Bitcoin is to you. And I wonder if hopefully, can we start to see this dynamic with poorer people in this country?
Yeah, absolutely. I mean, yeah, that's a good point. And what Nigeria, they either ban Bitcoin or they're trying to ban it. They've been talking about it, the government. And we've just seen a huge uptick in local Bitcoins and peer-to-peer trading a Bitcoin and buying a Bitcoin over the past few weeks. And so, yeah, I mean, you can't ban it. You can only ban yourself from Bitcoin and the rest of the world. And so, yeah, I pull up charts frequently looking at Bitcoin compared to other currencies like the Turkish lira and the Venezuelan dollar, the Argentine peso, and I mean they're just skyrocketed way more than the U.S. dollar and Bitcoin chart. So yeah, I mean these people who they've been kind of taken advantage of for so many years, right? That wealth divide has just been increasing. They're learning and they're catching on and they're buying Bitcoin. And I hope that more and more of them continue to buy Bitcoin, and because I mean it's a safe haven. It's a safe haven asset. They can store their time and wealth in it, and it doesn't get inflated away by someone else, right? Someone who gets a say in how the money is handled and printed and interest rates and things like that, right? Bitcoin, no one has a say. It's programmed into the code, and it's built on consensus, and it's just a much better money, and it's ethical money, it's sound money, and it's fair money. And yeah, people are they're learning, and I think that trend is just going to continue to accelerate and go parabolic.
Yeah, man. Yeah, I
Yeah.
think the biggest detriments are going to be the media and kind of incumbent ideas we
Hmm.
have in education
Yeah.
and in the education system, which preaches current economic Keynesian economics essentially.
Yeah.
Um, but it's very interesting because if you follow it like we do, you see all these civil rights issues, you see all these issues around the world where it's helping out the least advantaged people. However,
Hmm.
in this country, and in the media, all you hear about are the big players buying it. All you hear about is
Yeah.
it being speculative. So I could see lower income people or people who don't have a good knowledge of Bitcoin seeing this in the media, reading it and being like, oh, it's just another one of those things that the rich people are doing. It's this tech thing. You can't understand it. It's not going to work for the common person, when it's actually just the opposite. And I hope that it being pitched as just this new kind of tech game or scam, man, I hope some people can start to see through that, because it's not just for Michael Saylor and Elon Musk.
Yeah. Yeah, no, you're exactly right. I mean, yeah, it's terrible. We see Janet Yellen say it's, oh, Bitcoin's used for illicit activities, or it takes up a lot of energy. I mean, she has no idea about Bitcoin, and it's sad that people are going to listen to her, take her advice, because it's poor advice, and it's unfounded, uneducated advice. But
yeah,
do your own research.
As I've heard Michael Saylor say, a lot of people know just enough about an asset class to hurt them. You find out one or two facts and you let it hurt you. And if you don't have a full analysis of the subject, that fact is meaningless. If you say Bitcoin's used for illicit activities, well, compared to what? So compared to the dollar, no, it's not. Yeah. And if it uses a lot of power, it's like, compared to what? And these arguments completely lose water once you try and have a realistic analogy.
Yeah, that's exactly right. Yeah, same with the energy thing, right? It's like, Bitcoin uses a lot of energy, but compared to what? Compared to the legacy fiat system? Yeah, no way. It's way less, and it uses a lot of renewables. And the fiat, I mean, the Fed alone employs 60,000-70,000 people, something like absurd. For the Fed, I mean, it's just doesn't make any sense.
Yeah, I mean, you and I could save a lot of energy if we walked everywhere and never used a phone or a computer. And those are true statements, but they don't say anything about the value.
The economic good that it brings. Yeah, exactly. Yeah, it's just poor arguments, very poor. Very sad to see.
Yeah, you're just sending out this news people are reading on their, $1,000 smartphone that's in their pocket, and you're telling them about how Bitcoin's wasteful. It's pretty stupid.
Yeah, yep. Agreed.
All right, another block of Bit Center in the books. Thanks for watching, tuning in. Don't forget to like the video and subscribe to our channel. We'll see you next time.
Yeah, thanks again for watching. Follow us on Twitter, and as always, we'll leave you with an awesome Saylor quote.
The stupidest thing you can do is sell your Bitcoin. Don't sell your Bitcoin.